Hi, I'm Pattu from freefincal. Let's take a look at PlumbLine for January to March 2021. This is a list of handpicked mutual funds to accompany the freefincal robo-advisory template that was launched in September 2017. Before we get started, I would like to wish all of you a very happy, healthy, prosperous 2021. And in 2020, 443 articles were published at freefincal.com. They were viewed 5.3 million times cumulatively by more than 3 million visitors. The views have gone up by 50%. The visitors have gone up by 66%. I would like to thank all of you for your enduring support. Before we get to the PlumbLine list of funds, I would like to make one more announcement. My course, Goal-Based Portfolio Management, there's a set of videos run in a Facebook group, now has more than 2,000 members. It's now available on offer. You only need to pay rupees 1,800 one-time fee and join the course. This is a 40% discount from the full price of rupees 3,000. This offer is available only until January 3rd. After that, the price will be only the normal price will be applicable, and any other future discount will always be at a higher price, and therefore this is as good as time as any to enter the course. Now, if you would like to know more about the course, you can always click on this link. I'll leave this link in the description. And there are a couple of videos. The first video is free. I think one more video is also free. I'll link all of them below. You can have a look at that and then decide to join. But the offer is only available until the 3rd of January. All right. So, and if there are any new mutual fund investors watching this video, I have an ebook. It's a free ebook which has 100 essential questions that beginners should ask and start investing in mutual funds in the right manner. You can download the ebook in this PlumbLine link. You can go to the community tab, or you can just go to freefincal.com, head to this list of mutual funds article, and it's available there. All right, so we'll start with the funds. There is a very long disclaimer and terms and conditions associated with this, with the use of these funds. I would require you to read those before you use these funds or take these recommendations seriously, because I think it's quite important to do that. So please do go to the community tab, link or search for the article. It's right there on the top. Read the disclaimers, the what is PlumbLine, what is the intention of starting it, etc., and so on, and then only take these fund names seriously. So liquid funds, investments of few months and above, quantum liquid or parak liquid fund. These invest in short-term bonds up to 91 days in maturity. You can use it for parking money. You can use it even for medium term or even long term goals. Don't expect a little more, not too much more than SBI account. You'll get like what, 3-4%, 5% maybe sometimes, and so on. If the interest rates increase, you might be able to get more, but don't expect too much money. It's just for parking. These invest in good quality bonds. The interest rate risk would be low. The credit rate rating risk for these two funds at least is reasonably low. Equity arbitrage. ICICI equity arbitrage, these invest 70% to 65% to 70% would be in arbitrage opportunities. Most of it would be cash and carry arbitrage. I've explained this before, and the rest of it will be bonds. This fund does invest in reasonable quality bonds. Not all of them will be high rated bonds, but that's something that you'll have to take a look and check for yourself. But this is something that I use myself. Some part of it is used as an emergency fund, some part of it is part of my son's future portfolio. But you should understand the ins and outs of arbitrage funds before you invest in them. Typically, they have a debt fund like volatility, but when the market becomes volatile, the situation becomes uncertain, then the arbitrage opportunities will reduce and the returns will come down. So you have to be careful about those. Volatility of these funds can also increase during a crash, etc. Money market funds Money market you can use for 1 year and above. I recommended 3 funds. Franklin India Savings Fund, there's nothing wrong with this fund. It's managed to stay afloat in spite of all the problems Franklin had. 75% of its AUM has fallen down, but still the NAV is doing well. There's no problem. ICICI Money Market, HDFC Money Market can also be used as alternatives. These are bonds that invest in short term for short terms, and they invest in the money market. That is, the cash itself is a commodity here, and the interest rate risk would be low. The credit risk would be there, but typically funds in this category invest in reasonably high rated bonds, but you have to be careful. Including Franklin, even before all these problems, they were investing in high rated bonds. 10-year Guild, SBI, or funds from SBI or ICICI can be used. These are for very long-term investments. You have to have a proper asset allocation. You have to do proper rebalancing and portfolio management. Otherwise, these funds can be very, very risky. This will invest in. This is as good as an index fund, but the expense ratio would be high. Some people have asked why not a fund that times the gilt, the interest rate cycles and so on. I myself have invested in a fund like that, ICICI Guild fund, or there's another option called SBI Guild can also be used. But the risk there is very high, especially the fund manager risk. I am comfortable with those risks, but if you are comfortable, you can also consider that. But in general, the 10-year Guild is safer in the sense that the fund manager will not modify the tenure of the bonds as rapidly like they do in the other Guild funds. So you'll have to be careful with that. ELSS funds, please don't use ELSS funds if you can manage the ATC tax saving within the fixed income part of your portfolio. There's really no need for that in my opinion. But Aditya Birla Tax Relief 96, DSP Tax Saver, they have very good consistent track records. Parak Parik Tax Saver, which is also a clone, almost a clone of the Parak Parik main fund, except for the international equity, that also can be considered. The balanced funds or aggressive hybrid funds, you can use HDFC Hybrid Equity, ICICI Equity and Debt, and MultiAsset. The ICICI fund, hybrid fund, they all have very good track records. Multi also has a slightly newer fund. It's got low expense ratio, but I think it has also done well. Canara Robeco and SBI funds have also have a good track record. You can consider any one of them, but they should be considered purely as equity funds. Don't take the fixed income parts of the portfolio seriously. Multi-asset funds, I use ICICI multi-asset. This has got about 70% of it as in equity. It has a little bit of gold. I think it tries to time the exposure to gold a little bit, but you treat it again as equity, but don't expect it to be of lower risk. This is a equity-oriented multi-asset fund. There are many other multi-asset funds where they have equal proportions of equity, cash or bonds and gold. I would prefer this for a long-term gold. It will be slightly less volatile than a diversified equity fund. Balanced advantage or dynamic asset allocation. ICICI Balanced Advantage, which has a tactical asset allocation strategy. If you have a habit of looking at the ICICI mutual fund fact sheets, they produce a market valuation model based for equity market and also bond market. Their ICICI Guild fund uses their debt valuation index, and Balanced Advantage uses their equity valuation index. Flexicab, that's a new category. Instead of the multi-cap, you now have Parak Parik as the Flexicab fund. There's a very good track record, low volatile track record, but of course the AUM will start increasing now because of its all the attention it has garnered. But that's inevitable. You can't do anything about it. I use it myself. I earlier had quantum long-term equity in this category, but it's, of course, technically it's a value-oriented fund. But I put it as a multi-cap category earlier, but I have removed it because not many new investors would have the stomach for it. But I am still invested in quantum long-term equity, and I have just shown that the performance has got better recently in my audit. Now, coming to the index funds, if you want purely large cap oriented index funds, that is Nifty or Sensex, Nifty X50 is not large cap. You can choose the UTI Nifty, HDFC Sensex, or HDFC Nifty funds. I've shown that they have a reasonably low tracking error. You can have an index blend for 50% Nifty and 50% Nifty X50 if you like. Nifty X50, you can choose UTI or ICICI funds. And if you are choosing slightly different blends, like that is what I mean to say is that slightly lower risk. This 50% Nifty 50 and 50% Nifty X50, this will be almost like having 50% mid caps in the portfolio. If you want slightly lower proportion of mid caps, then you can go for a slightly lower weight to Nifty X50. However, if you reduce the weight below 20%, then there's no need for a separate fund. You can just use Axis Nifty 100. Axis Nifty 100 will act like 10 to 20% Nifty X50 and remaining Nifty 50. But if you want more exposure to Nifty X50, then you have to do it separately via these funds. Multi-cap and small cap, with Nifty X50 so hard to beat, it's very difficult for me to recommend multi-cap and small cap funds in this category. So I would give you some results, but these are facts given from the mutual fund screener. DSP mid-cap, Invesco mid-cap, L&T mid-cap, Kotak emerging mid-cap, or the emerging equity scheme. Those are the mid-caps which have a very good track record with respect to Nifty mid-cap 150, not Nifty X50. But that's a fact. I'm not recommending these funds, and I've also not recommended small cap funds. But I have talked about how, if you are investing small cap funds, you should have some kind of timing strategy. Otherwise, it will be too volatile for you. So that's about that. I have also explained this timing strategy earlier. You can have a look at that. So that's about that for this quarter's PlumbLine edition. And I'll catch you later. Bye bye.